Tonight on Market Call, we've got Jeffrey Olin. He's the president and chief executive of Vision Capital Corporation, and he'll be taking your calls and emails on Canadian real estate investment trusts and real estate companies in general. Good evening, I'm Mark Bunting, and welcome to Market Call tonight. This is the Friday edition. As mentioned, we're talking REITs and real estate operating companies, so you can give us a call if you like at 1-877-667-6288. If you're in Toronto, dial direct at 416-957-8199, and you can get us through email at marketcall@bnn.ca. Welcome back.
Thank you very much.
Nice to see you. Let's just dig right into this. Let's get right into the good old basic fundamentals of real estate. Supply and demand. What's the equation looking like right now?
Well, the supply and demand fundamentals in Canada right now are excellent. We've had limited new supply in most major asset classes and regions in the country, other than the Calgary office market and the Toronto office market. And demand has been stable. We've had employment growth, employment levels now back to where they were before the recession started. So we have single-digit vacancy rates in most asset classes in most regions, and we're healthy, unlike some of the problems down south.
Right. Now, I noticed in your notes you're calling it yield fever, and this has been going on for a while. Everybody's looking for some kind of return, and that, of course, plays right into the hands of the REITs and the real estate companies, right?
Yeah, I mean, this is a general market phenomena for sure, and it's impacting the REIT sector because they are a yield play. And I think that investors need to be cautious that they're not fooled by high yields. I mean, you can go back to the income trust phenomena where you found companies to play into the real yield fever. We're going to the bank to borrow money to pay distributions. And so I don't know any business that you've ever valued based on how much one would pay out of their cash flow on a yearly basis. It's what is the cash flow that matters.
Right, so you can't just look willy-nilly at a company and just because they have a 10% yield. You don't want to buy that. You want to look under the hood and see what the company does and what the business is like.
Indeed. We look for total return, and certainly yield can be a component of it, but you can have very profitable investments that pay no yield. And the key is to look at what the total return is going to be from your investment.
Now, Jeffrey, there are some new accounting rules coming. How will this impact the real estate sector?
Quite significantly. We have IFRS coming, International Financial Reporting Standards, and for years under GAAP you had book-based accounting where the historical cost of an asset was what is reflected on their balance sheet. Well, beginning in January, we have for the first time market value accounting. So a company that has owned a piece of real estate, a building for a long time, may be on their books at a low cost and may have a much higher market value, and you're beginning to see that in the earnings results that have come forward in the last couple of weeks. You've seen companies begin to report IFRS values, which validate largely what analysts that do cover particular stocks, because many aren't covered, which is where IFRS comes particularly handy in terms of what we do in managing those that aren't covered well or sufficiently. Will highlight where there is value that exceeds or is lower than the current share price.
Now, just lastly, before we take a quick break here and start taking calls and emails for you, one of the trends that we've heard about from other people who cover REITs and the real estate sector is the fact that we know the trusts have to, and we've seen many of them do it already, to convert to corporations. Are you seeing a big money flow into REITs?
We've seen that occur. We think it will continue. Certainly a large part of it has already occurred, but we're still seeing money flow because of SIFT rules, because of yield, and because the fundamentals are generally sound.
All right, Jeffrey Olin will be taking your questions right after this about real estate investment trusts and real estate companies in general. So join the chat, and we'll see you after the break. Let's start with Marcy, who's in Toronto. Good evening.
Yes, hi, good evening, gentlemen. I'm calling about the Crombie REIT, and I'm just wondering if you can comment on it and if you think it's a good buy at the current price level. Thank you very much.
Thanks, Marcy. What do you think of Crombie?
Well, Crombie is, hopefully Marcy knows, is in the shopping center industry in Canada, and they benefit from having a strategic relationship with Sobeys, which clearly provides in many of their centers lead grocery store anchor tenant, which is key. So that's a benefit to Crombie. I've toured some of their properties, not recently. I would say they're middle-of-the-road properties. Some of them suffer from some deferred maintenance. We would call it a hold. It would not be our favorite pick in the sector.
Now, we noticed Crombie's chart there, and I have a feeling we're going to see a lot of REITs looking pretty similar. Are they up around levels that are getting maybe a bit frothy, or is it sort of stabilizing and they're looking okay generally from a valuation standpoint?
Well, certainly most of the REITs, as you have suggested, have had a very good run, and so you need to be much more selective, and as I mentioned earlier, you need to focus not just on yield but total return, and what we're doing in our portfolio is not just looking at REITs that pay a significant yield, but a total return, whether it be a REIT or a real estate operating corporation, and we're still finding some compelling value in real estate operating companies and selectively in the REITs. But, you also have to look where they came from. Most of them had a precipitous decline, as many securities did.
Right.
And so some of them are just approaching the levels that they were trading at before the decline.
All right, Jeffrey, we're going to talk to Fred, who's in Stratford, Ontario. Hi, Fred.
Good evening. Thanks for taking my call. My question is about Temple REIT, which apparently they own some hotels in oil sand areas. I have taken a fairly large position in this stock, and it seems like the stock wants to work its way up the chart from the bottom, and I was wondering what you think about it and if you think it's a good turnaround situation. I'll hang up and listen. Thank you very much.
Okay, thanks, Fred.
Well, Temple REIT is a high-risk, high-reward opportunity. It is highly leveraged to hotels in Fort McMurray. So when Fort McMurray was booming, Temple REIT was doing well, and when Fort McMurray suffered due to the oil sands settling down, Temple REIT suffered. So hotels can be risky generally. We generally don't have a lot of hotels investments because your tenants generally are there for one night. And particularly with the concentration of risk in Fort McMurray, you've got to be careful in Temple REIT. If you feel strongly that Fort McMurray is going to do very well, you're probably going to do well in Temple REIT. But it's something to be cautious of. It's got a high risk component to it.
This has a market cap, Jeffrey, of $35 million. Is that too small for your liking?
No, we don't have upper or lower limits. We know the entity well. Again, I've toured many of those assets in Fort Mac. One of the issues in Temple REIT is that the management has a propensity to like a lot of debt, and so just as they're leveraged to one market, they have a considerable amount of financial leverage that they're comfortable with, and investors have to be comfortable with that approach in investing in that name.
Let's move along to Bill, who's in Collingwood, Ontario. Hi, Bill. Go ahead, Bill.
My question is on Crombie REIT. I'd like to get your guest's opinion. I'll hang up and listen. Thank you.
Crombie.
Well, Crombie is the clear leader in the Quebec marketplace. They have a dominant position in commercial real estate in Quebec. There's very strong management. It's a stable REIT. We don't own it. It tends to trade on at a premium. Quebec investors love it because they know it. They see their properties. We would call it a hold. We don't own it. We have owned it in the past.
Where would it need to come back to in terms of price to be more attractive?
Well, again, we would have to, in our view, be trading a significant discount to some of its peers, such as First Capital or RealCan or Callaway. It's shopping centers. They're diversified. They have office buildings for it to be compelling.
All right. We'll talk to Grant now, who's in Calgary. Hi, Grant.
Hi. Can you give me your opinion on Hamburg? And I will say up front that my wife has a position in RealCan that she's had for years and years and years, and I think she bought it at 9 and change. And I own XRE that I've had for probably 5 or 6 years. But I was thinking of looking at Hamburg. I know they don't have the best properties on the market, but the yield isn't bad, and I think it might be all right for like a yield play for the next 5 years. Thanks. Bye.
Thanks, Grant.
Thanks for your question. Again, you've got to be cautious about focusing any investment strategy on yield. Entities often have a high yield for a good reason. And in the case of Hamburg, as you pointed out, they're not the highest quality properties. We don't think the management is as aligned as we like to see them. And it's a name that we don't own and won't own.
So the being aligned, meaning the management does not own enough of shares to make
they
it...
own enough. It's quasi-external management structure. It's the major shareholder has had a bit of a checkered history in terms of real estate success, some great wins and some great losses, and it's a name that we're not a fan of this REIT.
Now, the caller, Grant, mentioned XRE, which is a real estate, or is a exchange-traded fund, tracking REITs. Do you have any interest in it? Do you hold XRE? Or?
We don't hold XRE.
No?
We might use it as a hedging vehicle in terms of our fund. We can be long and short, but we don't own it. We think our investors pay us for our expertise, not to buy an index.
Right. Fair enough. That makes sense. A quick break here with Jeffrey Olin talking about real estate investment trusts and real estate operating corporations as well. We'll come back with more phone calls and emails after this. We've got Alex on the line in Ottawa. Hi, Alex.
Hello. Hi, gentlemen. I'm calling to find out your guys' opinion on Canadian REIT. And more generally, I hold about 14% of my portfolio, my RSP, in REITs. And I was wondering if you could give me some feedback. I have them split between First Capital REIT, Canadian REIT, H&R, and Killam Properties. Thank you.
Sorry, you were tailing off there. Your names were First Capital.
First Capital, H&R. You still there, Alex?
Yep, Canadian REIT and Killam.
Okay, so those are the four, making up 14% of his portfolio.
Well, certainly the percentage of your portfolio with real estate exposure is reasonable. At 14%, could grow a little bit in our view. Certainly, you've got some good names there. You've got some quality names. We know all of these entities quite well, particularly First Capital, Killam, H&R. First Capital is a very high quality name. It's a core holding. They're the leading player in grocery store and drugstore anchored shopping centers in the country. They're structured as a corporation. They have a reasonable dividend. They do development, so they're value-added players. They're extremely strong alignment with management and outstanding management.
And the ticker on First Capital?
FCR.
FCR.
Killam Properties also we know well in our former careers. We actually financed both First Capital and Killam in a lead capacity, so we know them well. We know their properties. Killam, in our opinion, has good properties. They're good managers. They suffered, in our opinion, for some time with respect to company building as opposed to shareholder value building, but we think they're on a track now. They've announced some new developments. For the first time, you're going to see some value-added activities out of Killam. And they recently announced an acquisition in extremely compelling terms. I mean, they bought it with a 300 basis point spread between the cap rate that they bought it at and the financing rate. So that's pretty accretive. You can get 15 to 20% return on equity.
Just to stop you there, just for those who don't know REITs that well, cap rate is?
Cap rate is the return on cost. It's the net operating income divided by the value or the cost of the property. So it's a reflection of the unlevered return on the investment. Mm-hmm. H&R, again, a large cap, high quality REIT. They were in the penalty box because of the Bow development, which they didn't have construction financing 2 years ago. The REIT's unit suffered. They've come back a long way. It's quality. We don't own it. It's external management. We don't particularly like that aspect about it. We have owned it in the past. CREIT, another granddaddy, one of the longest standing REITs, a diversified commercial REIT, solid properties. In our view, tends to have an overvaluation because it's one of the mature large cap REITs. So we don't own that. We think there's other better values. And so of the names you've mentioned, we would think First Capital and Killam would be the better names.
Alex in Ottawa just got a really nice bonus there. You covered every single REIT that he owns, and now he's got a better idea of how he's doing. Let's stick in Ottawa, and we'll talk to Don. Hi, Don.
Hello, Mark. First, a general statement or a general question. When I evaluate the REITs, you say not to look at the dividend. The only other thing I have is payout ratio. And I look at payout ratios of 100, 110, 115%, and they're still paying. It confuses me. The easy question is Callaway REIT. I'd like your comments. Thanks.
You're welcome. Well, you hit the nail on the head. And if I said don't look at yield, I'll take that back.
No, you didn't say that. You just said not exclusively.
Right.
Anyway, yeah.
Look at total return. So yield can be a component of it, and we do look at yield, but one shouldn't get fooled by yields that are too high or too low. And certainly payout ratio is a good example of that. You can have a high yield, but if your payout ratio, which means that you're paying what percentage of your cash flow you are paying out in terms of a dividend or a distribution in the context of REITs, that is the key factor. So the comment with respect to REITs is when you're looking at REITs that are paying out more than they're making, that's a problem. That suggests it can be a problem. In some cases, REITs can and have grown into their distribution. Callaway REIT, again, solid entity, large cap. They're strong in power centers. The principal owner, or largest shareholder, I should say, of Callaway brought Walmart to Canada, so they enjoy the benefits having a number of Walmart-anchored shopping centers. There's some stability there. There's a recent development in the last 2 days of Callaway where they had the earnings results, and in order to qualify to continue with REIT status, they had to deal with some mezzanine loans. There's a relationship between the major shareholder in Smart Centers, a private company, and the REIT, where the REIT had lent money to Smart Centers, and that didn't qualify as eligible income for REIT. So they had to do something about that, and what they've done to do about it is that the REIT is buying those developments, which are developments in progress. And there's some question, and we haven't opined on it yet, but there's some question as to the value that they're paying, and we just haven't a chance to assess that and analyze that in terms of are they paying a fair price or too much for the developments, which have a higher risk element to them.
Would you want to talk to management about that?
We certainly can, and we're analysts have been looking at it as well. I think the analyst community is looking for more information, so hopefully they get that, and through that we can also get educated.
All right, we'll move along. We'll talk to Fern, who's in Thornhill, Ontario. Good evening, Fern. Hi there.
Hi. I was just wondering if you could give your thoughts on BPO, Brookfield Properties, please, and where you think it might be in the next few years.
Brookfield Properties.
Thank you.
Well, Brookfield Properties is arguably the highest quality in terms of assets of a real estate entity that's publicly traded in Canada. In fact, it's traded in the United States as well, and the majority of their income comes from the United States. I believe the number is about 40% of their net operating income is derived from New York-based, Manhattan-based office buildings. Very high quality, exceptional management, a strong sponsorship from Brookfield Asset Management, which owns 50% of it. Really, your bet on Brookfield is your call on what's going to happen to office markets, again, primarily in the United States, and particularly in Manhattan. So if you don't believe we're going to have a recession and you believe that Wall Street is going to continue to do well, we think Brookfield's a good name. They know what they're doing. They're very aligned. We don't own it at the moment, but we do own the parent company, Brookfield Asset Management, which owns 50% of Brookfield.
Right, which came out with earnings today, if I'm not mistaken. And we've seen this one triple from the March 09 lows. You're comfortable with the valuation here, 1863?
Yeah, I think it's reasonable. I think you've got to look at it in context of other peers, and I think you find that it's reasonable value.
Okay, a solid recommendation from Jeffrey Olin on Brookfield Properties, and we'll find out what his past picks were when we come back after this. Let's look at the past picks now from Jeffrey Olin, President and CEO of Vision Capital Corporation. We're only going back 3 months this time around to July 28th of 2010, and these returns are impressive. Total return average here, 40% for Jeffrey with these selections. Parkbridge Lifestyle Communities, PRK is the ticker. You recommended this at $5.20. It's up 40%, but there's a unique situation here. It got a takeover offer.
It's a unique situation. On the 4th of October, a BC pension fund announced a proposal to acquire 100% of the common shares of Parkbridge at $7.30 a share. It certainly validates what we've been saying, that this was an asset class that is not well understood in this country. It's the purest form of cash flow in the real estate space. And, well, we haven't seen another bidder come up. We think the price is too low, and we're deliberating as we speak as to what paths we may take to effect some better results from our view.
Meaning you might...
Well, whether we vote yes, whether we vote no, or whether we can potentially help identify an alternative bidder. But we think the price is too low.
Do you have a significant stake in Parkbridge?
Not enough to on our own effective outcome, but we have approximately about a 4% holding in Parkbridge.
Okay, we'll see how that plays out. Main Street Equity, you recommend that at 10.85, it's up 18%. You're still holding this one. What do these guys do?
These guys are in the apartment business with a focus in Western Canada. They are true value creators. The CEO, Bob Dylan, is an entrepreneur extraordinaire.
I won't make a joke there.
He's, we're not the Bob Dylan. But Bob has basically grown a company from 298 apartments in 1998 to over 6,500 apartments today.
Wow.
With but net equity of $10 million. So he's a true value creator. We believe this is significantly undervalued, and we continue to own it.
And Edulin, am I pronouncing that correctly? Edulin.
Yeah, great company, not a great name. Edlian.
Edlian.
It's an acronym for Education Learning Universe. This is, again, a very unique opportunity. They're a consolidator of child care centers, daycare centers in this country. And this consolidation has taken place in every major Anglo-Saxon country in the world, except Canada, where the top 5 owners own less than 1% of the universe. And so there's an opportunity to increase the professionalism of this industry, which is sorely needed, and where demand greatly exceeds supply.
Now, you've got some disclosure here. You're on the board of directors, are you not, of Edulin?
We are the largest shareholder of Edlian, and I am on the board of directors.
All right, we're going to talk more about that company later because it's also a top pick that's coming up. You recommended that at 67 cents, by the way. It's up 61% since then in just 3 months. Nicely done. We will talk more with Jeffrey Olin right after this. We've got a half an hour to go. He's taking calls and emails on real estate investment trusts and real estate operating corporations. So come right back after this. Before we get back to the phones, we want to talk about Jeffrey's fund here. I mentioned that he's the president and CEO and co-founder of Vision Capital Corporation. Now, you have 3 funds, all of them real estate related. One of them we're focusing on tonight, Vision Opportunity Fund. Over 1 year, it's returned 40% compared to the S&P TSX Capped Real Estate Index, which returned 25%. And over 2 years, it's returned 31%, and the real estate index is up 5% over that time. So you're nicely outperforming. Tell us about the details of this fund.
Sure. Well, the fund was founded by my partner, Frank Mayer, and myself. Frank was formerly a top-ranked analyst for over 35 years in this country, and I have 25 years' experience in the area. So we feel we have an experience level to it and a knowledge of the universe, particularly in Canada, that allows us to identify inefficiencies in the pricing of Canadian real estate securities. We believe the market is quite inefficient. If you own a Royal Bank or RIM, perhaps the market prices those based on efficient basis, but not in Canadian publicly traded real estate. So we have a focus in real estate. We have a focus in Canada. Notwithstanding, we have the flexibility to invest globally. We can and we do take concentrated positions in our best ideas. We operate long and short. We tend to use our short positions not to make speculative bets, but to hedge in a true sense of the concept to take advantage of those inefficiencies. And we seek to be active investors, and not hostile, but active investors. Our returns since we launched in July 2008, I think we're up about 86%, which are nice returns, particularly with the tough times in 2008. But of equal importance to us and our investors is our risk profile. If you look at some of our risk metrics, some of the technical terms of standard deviation and Sharpe ratios, you'll find that our risk level is about half of the S&P TSX Composite Index.
And you're fairly focused. You're usually holding about 20 securities?
We typically own about 20 different positions.
All right, interesting. So there's your little background on the fund there from Jeffrey. Let's talk to Bob, who's in Toronto. Go ahead, Bob.
Hi. I'd like your guest opinion on Boardwalk, and how would he compare it against Cap REIT?
Well, Boardwalk is, again, I believe it's the largest capitalized residential REIT in Canada. We know the entity well. It's well managed. It's trading around its net asset value. based on the value of the real estate, has a relatively, one of the viewers asked about yield, a relatively low yield because of the large capitalization. It's well managed. It's at a conservative balance sheet. They're sitting on a ton of cash on the balance sheet. There's been a great deal of speculation what they're going to do with that cash, whether they're going to increase their distribution, whether they're going to buy back shares, or, as they have in the past, do special dividends or distributions on an occasional basis, and our bet is they will do the latter. We don't own it, but it's a quality name.
It's on your radar, always?
Always on our radar, absolutely.
And the yield here is 4%. Let's go to Winnipeg now. We're going to talk to Kim. Hi, Kim.
Evening, gentlemen. I've been involved with RealCan now. Well, not through a choice, but through buyouts and mergers. It was Real Fund originally, like 20 years ago. And that was a 4-to-1 split. Now being stuck with RealCan, okay, maybe the past 4 years it seemed to come back up, but not from where it was 5 years ago. Like, I'm actually getting a little fed up with it. So what is your opinion on that?
Well, RealCan is a high-quality name. It enjoys a premium valuation because it's the largest cap name. They have a significant position of influence in the market in retail shopping centers in this country. Eddie Sunshine is extremely capable senior executive, as is his management team.
We had him on BNN just a while ago.
There you go. Yeah. Well, you know, if you're an American investor and you're looking at Canadian REITs, which they should be, and some of them are, it's the first name you come to because it's got liquidity and it's got scale and it's well known. If you're a new tenant, you know, coming into this country, Marshalls or any of the Americans coming in, you know, RealCan's going to be amongst your top 3 calls because of their dominant position. As a result, it does enjoy a premium valuation. It was subject of some controversy, criticism that they were overpaying in terms of the payout ratio of their distribution. The CEO made a very strong stand and said by the end of next year you're going to find that they're not overpaying, and so far he's been right. They've been acquiring properties in the United States at compelling values. We don't own it at the present time, but it's, you know, I wouldn't, it's a kind of name you can buy and rest well.
Yeah, not knowing Kim's situation entirely, do you think you should hang on to this because it has bounced back with the markets from the March 09 lows, and it's nowhere near its all-time highs back, well, $27 back in 07, I guess. Do you figure ultimately we'll get back to those levels?
Ultimately, yes. We would call it a hold at the present time, but it's a quality name. So.
Yeah, and we're going to take a quick break here, but I want to ask you just quickly, what are some red flags with real estate companies? You mentioned too much debt. You mentioned when management is not aligned with shareholders. What are some of the other things that stand out for you?
Well, focus. You know, you want a clear strategy, able to be in too many asset classes or too many regions. It's hard to be an expert in every market and every asset class. So that's one issue for sure. You know, not only the amount of leverage, but how that leverage is structured. Is it longer term? Is it shorter term? Is it fixed rate? Is it floating rate? Clearly, what the key issue we look at generally in real estate is supply and demand fundamentals for that type of property in that market. It's pretty much more important than any other statistic, as it is in most businesses. What are the supply and demand economics?
Which we talked about off the top of the show. All right, Jeffrey, a quick break. We're going to keep taking calls and emails for you coming up after this. Off to Montreal we go to talk to Drew. Hi, Drew.
Yeah, hi, guys. Great show as usual.
Thank you.
Mark, I'd like to ask your guest, Jeff, about Morguard in particular. I noticed it's close to where its 52-week high was and where the parent company wanted to take it over at one time. What does your guest think of that? And a general question, I'd like to understand how your guest can explain how these guys can keep buying at overall capitalization rates below almost or equivalent to what their payout ratio, their payout is. If you could explain that, I appreciate it. Thanks, guys, and I'll hang up and listen to your answers.
Thanks for the call, Drew.
Certainly. Firstly, just to clarify, we're talking about Morguard REIT or Morguard Corporation?
Morguard REIT.
Morguard REIT. So Morguard REIT is a diversified commercial REIT. We think that it, relative to other names in the same space, is reasonable value. We recently purchased some units of Morguard REIT. Your question, I'm a little bit confused by your question. You're talking how they can buy related to payout ratios. I think the answer why they can continue to buy perhaps at lower cap rates or higher values, to get the real estate technical terms put to bed, at higher values, one of the key reasons are financing rates, the cost of money. So even though cap rates may have come down, values have gone up, if the borrowing costs have come down on an equivalent or greater basis, there's still a sufficient spread to make it accretive or profitable for the REIT to acquire. And so you've seen a flurry of acquisition activity, and of course capital markets have opened up to allow for the equity support for those acquisitions, and debt markets have been there, and that indicates a very active time frame for REITs.
We've seen Morguard shoot higher the last 4 or 5 sessions. Is that news related, or what's going on there?
They've come up with some decent results, and I think they had some catch up to do with the rest of the sector.
All right, we'll talk to Mara now, who's in Toronto. Hi.
Hi. Your view on Allied Properties, please, AP. I'll hang up and listen.
Certainly. Allied is a very unique entity. Their focus is on, what's the word that they use, but it's basically historical or heritage buildings, or I-class is what they call it, real estate. So they own a lot. If you're familiar with Toronto, I don't know where you're based, but around King and Spadina, Bathurst and King, where they have a dominant position in that marketplace. Brick and beam buildings, they go in, they retrofit them, and they have a unique and loyal clientele. They have some retail space. We like the name. We don't own it at the moment. What we particularly are intrigued about is they've ventured into a different asset class, known as telecom hotels, or basically data centers where they house the data requirements as opposed to people. And they bought one again in downtown Toronto. They're just retrofitting one of their existing assets. Very high return per square foot, very expensive to operate, very expensive to have the infrastructure in place. But it's an interesting space, and we hope they actually do more of that.
So they're quite focused generally in the main part of the business, and they're branching out, and you're comfortable with what they're attempting to do.
Absolutely, we like it. We like it, and Mike Emery, the CEO, is a very competent manager.
All right, very good. We'll move along and take a quick break and be back with Jeffrey Olin right after this. Let's talk to Larry, who's in Toronto. Go ahead, sir.
Good evening, Mark.
How are you?
And Jeff.
Good evening.
I'll keep it simple. I've sort of got Invest REIT in my crosshairs, and I like a return as well as a potential for a capital gain. And the question is very simple: buy, sell, or hold Invest REIT. And I'll hang up and listen.
Thank you, Larry.
Good evening, gentlemen.
Thank you. Invest is in the hotel space. I mentioned earlier we typically don't invest in the hotel space, but we do own Invest. We think it's the quality name in the space. We think that the recovery in the economy is going to be good for hotels. Hotels are generally a leading indicator in the real estate space. They have some very high quality properties. They have some mid-grade properties as well. They're across the country. They have significant presence in Western Canada. Some of the core properties in Calgary and Edmonton and British Columbia. And we think that it's strong management. It's reasonably large cap, has a decent yield. I think it's around 7%.
Yeah, right on.
And so, it wouldn't be our top pick, but it's a good name and we own it, and I wouldn't hesitate to buy it.
All right, so there's a recommendation for Larry. Thumbs up on that one. Gordon is in Calgary. Go ahead.
Hi, gentlemen. My question relates to Northern Properties. Is this a buy, sell, or hold?
We've never owned Northern Properties. I guess we have a bit of a philosophical challenge with it in that what they do is they focus primarily on residential properties in northern parts of Canada and Newfoundland and up in very cold areas. And they've been able to enjoy decent cash flow, but the quality of their properties is not that high, and some of their properties benefit from the cash flow from strong leases, but the value of the bricks and sticks, independent of the specific cash flow at the moment, isn't very high. So we think this is a risky name, and we don't think its valuation, its price, reflects the risk inherent in the name.
Now, in your fund, Jeffrey, do you care that you are diversified across all real estate sectors and types of businesses, or does it matter? You don't want to be focused on the best companies, and if you exclude certain parts of the sector, that's okay?
Certainly we care in terms of we will have an opinion perhaps as whether office or retail or industrial residential is a good place to be, and once we've made that judgment, then we will look for companies and regions of Canada. I mean, Canada, as you know, is very much a country of regions where different economic drivers can impact different parts of the country at different times. So we will make a top-down assessment of asset class and regions, and then we'll make a bottom-up decision based on the specific company's management teams and the fundamentals of that entity. So we have, since inception, been quite cautious in our outlook, and so we've tended to have a heavy residential focus, including Parkbridge, which is residential in nature, and primarily because supply and demand fundamentals are sound, and we're blessed in Canada with CMHC, Canada Mortgage and Housing Corporation financing, which means even in the depths of the credit crisis, apartment companies in this country had virtually unlimited access to debt capital because of the benefit of CMHC guaranteed financing.
Which was a nice cushion for sure. Let's move along. We've got Richard in St. John's, Newfoundland. Hi, Richard.
Hi. First of all, I want to say that I really enjoy watching BNN, so much better than American business TV, and I think you guys should all get a good raise.
Oh, well, thank you, Richard. Tell our bosses, and thanks for watching, and thanks for the compliment.
Okay, and for your guest, two REITs, White Rock and BTB.
White Rock and BTB. White Rock, we don't own either of these names, and I would be very cautious of these names. White Rock is one of the REITs that is overpaying their distribution. They've done that for a long time. We're not a big fan of senior management. We think they're more financial engineers than real estate operating folks. At the CEO level, we're cautious of that name. We think that it's trading at a premium to net asset value. So that would be a sell in our view. And BTB is what we would call a make a REIT, which meant that there was some entrepreneurs that had some real estate skills that thought it would be nice to accumulate some assets and have a public vehicle. It's been challenged since inception, and it's a small cap. We don't know it that well, but we'd be cautious of that name as well.
And just back to White Rock, you sort of questioned the management a little bit there, at least in terms of their focus and abilities. But how often do you meet with management? Have you met with White Rock before?
We have met with them before, not recently. And it's not really a comment per se on. It's just the approach of management that we know the CFO well. He's very strong, so it's not a comment on the CFO. He used to be the CFO of First Capital. Frank Busey's strong, but the CEO came from the United States. He has a financial background, and I say they're very good at doing deals and structuring deals. Not so sure about the long term. We take a very long-term perspective looking at the quality of real estate, whether the kinds of deals they're doing are going to endure over the long term.
And when a company has a payout ratio over 100 for an extended period, are they borrowing in order to pay out the distribution, or how do they go about it?
They can be borrowing for sure. It has to come from somewhere. So on a long-term basis, if you have a systemic overpayment, you have to be getting the funds from somewhere.
Yeah, and at some point it's not sustainable, you'd have to think.
Exactly.
Yeah. And not to pick on White Rock, but the stock is way up.
No, there's a number of them.
Yeah, a number of them. But you're not that thrilled about that one. Let's talk to Stan, who's in Saskatoon. Good evening.
Yes, good evening. Mr. Olin, I'm fortunate in that I'm a pretty solid investor, but I must admit I'm a terrible investor, and I know little about anything other than the folks I give my money to. If I wanted to become, and I'm probably 15% in equities, the rest in GICs, so my return never has been great. My question quickly is, if I wanted to get into the REIT investment to where I'd get either a dividend quarterly and so on and so forth, and you'll probably be able to tell my question. I'm not a good investor, but what would you put the money into if you were an ultra-conservative investor, maximizing the return, minimal risk because of the stage of my life I'm at. So anyway, I'd like to hang up and listen to this, and I thoroughly enjoy your show. Thank you.
Great. Thanks for the call, Stan.
Stan, thanks for the question. I think one of the names we touched on earlier sounds like it might be a good selection for Stan. First Capital Realty, very strong alignment with management. The major shareholder, which is represented by the CEO, Dory Siegel, owns about 50% of the units. It's high-quality properties in major urban centers. They have an attractive dividend, emphasize dividend. It's not a REIT, it's a corporation. So when you receive the dividend from a corporation compared to a REIT, you get the benefit of a dividend tax credit, which gives you a bit of a juice in terms of the after-tax returns you're getting. It's a kind of name that I think Stan will be able to sleep well by owning.
Okay, First Capital. For Stan, who is an investor who's looking for a conservative REIT. Let's have a look at these top picks from Jeffrey Olin, President and CEO of Vision Capital Corporation. You heard about this one earlier as a past pick, and it's a top pick as well. Edlian Group, he recommended at 65 cents in August. Full disclosure here, they have a fair-sized stake in this company, and you're on the board of directors. And really interesting focus for this company.
Yeah, Edlian, which is an acronym that stands for Education Learning Universe, is really a unique entity in Canada. Canada is the last Anglo-Saxon country in the world that has not undertaken a consolidation of childcare or daycare centers. And Edlian is in the process of doing that. I mean, the United States, they consolidated, they went public, and in 2 transactions where Bain and Morgan Stanley bought out the 2 largest public companies, they've already been privatized. Whereas in Canada, the 5 largest owners own less than 100 centers combined. And so what Edlian is doing is consolidating this industry, and they're adding a level of professionalism, implementing curriculum and nutritional meal programs, branding, professional standards into the industry. And at the same time, because it's one of the few real estate sectors where demand is substantially in excess of supply, unlike other consolidation plays that we were involved in, Boardwalk and Killam, names we talked about earlier, which proved to be 5 to 15 times return on investors' money, which is why we own Edlian, as we see that kind of potential here. What's different about Edlian is because of the demand exceeding supply, they have the opportunity to do new development and create state-of-the-art centers. So we like it a lot, and you have to have a long-term view on this. I mentioned that kind of potential. It's over a 2 to 3 year period.
Okay, another top pick, Retrocom Mid-Market REIT, RMM.U.
Again, Retrocom, what we like about it and what is not well understood is the value-add component to it. The major shareholder is the same principal that's a major shareholder of Callaway. They have a high yield now, so you get paid while you wait. But what we like about it is they have a couple of properties with redevelopment potentials that potentially support the valuation of the share price as it sits today.
Okay, we're just a little squeezed for time. Quick thought on Exchange Income Corporation, EIF.
We're real estate focused, but focused is key. It's not exclusive. We're not monogamous. This is a non-real estate name. It's outstanding management. They have a $1.56 dividend. They have niche airlines where they have a competitive cost advantage, and folks should look at this name.
All right, very good. Edlian Group, Retrocom Mid-Market REIT, and Exchange Income Corporation, which is not in real estate. Great to see you. Thanks for coming in.
Thank you.
All right, Jeffrey Olin, we'll see him soon. Real estate investment trust and real estate in general. We hope you enjoyed that. Have a great weekend and do your research. We'll see you on Monday.